another change, big change to itemized deductions. And with medical expenses in the past, throughout the whole time I've been doing tax returns, medical expenses, to be able to deduct them, you've always had to have a minimum amount based on your gross income. All right, so historically that number has been anywhere from 7.5% to 10%. Well, for 2017 and 2018, that number went down from 10% to 7.5%. So that was a good thing. That meant that a lower threshold, more of your medical deductions or medical expenses could be deductible. Well, 2019, that number's back up to 10%. So that was just a little temporary thing that happened, and for some reason they decided not to continue it on through 2019. So that's changing, and just kind of have to plan accordingly for that. Huge change with the 2017 tax reform had to do with state and local income taxes. Now this is a big change because, and it's going to affect a lot of folks, because if you think about the type of deductions that you can get here, we're talking about state income taxes, property taxes on your house, property taxes on your car, and especially in high tax states. We're kind of a moderate tax state here in South Carolina, but tax states like California, New York, if you have business there, if you have, for some reason, you're paying income taxes in those states, the rate's pretty high. So unfortunately, what's happened here is it's not an elimination of the deduction, it's just a limitation. So that deduction now is limited to $10,000. All right, so no matter what you have, if you're paying even $50,000 of combined state and local and property and house and car and everything, you can only deduct $10,000 of it. That's the max. Yes, sir?
Yeah, property taxes on like an investment property, would that be included in that, or that still goes on?
Right there, your answer. The question was, excuse me, the question was if you have investment, property tax on an investment property, like a rental property. The answer is anything that's property taxes on a trade or business or a rental, that's still fully deductible, so it doesn't affect that. So yeah, good question. What's that? Right, if you're filing a rental property on Schedule E, that is still, that property tax is not subject to this limitation, the $10,000, correct. So again, this is something where, you know, we're going to have to really pay attention to this moving forward, because this can affect, especially if you have a high income individual, they're paying a lot of state income tax, and you know, also up in the northern states where the property tax is really high. There's folks, we have a few clients where just their property tax on their house exceeds the $10,000, and that's it, that's all they can deduct. They're done. All right, big change also with mortgage interest. So in the past, the mortgage interest limitation, you could deduct mortgage interest on your primary residence and your secondary residence of up to $1 million of principal. The interest on up to $1 million of principal. Now that number has come down to $750,000. All right, so basically, if you had debt incurred before December 15th of 2017, you're grandfathered in. But anything that's after that, the limitation is down to $750,000 of principal, and that can be still for multiple residences, but the overall limitation is in place. Home equity lines, this is something that did evolve throughout the year. When the 2017 tax reform bill was first passed, everything we saw and we interpreted as professionals looked like home equity line interest was no longer deductible. It was just a cutoff, cold turkey, no more. But the IRS, as you can see in February of 2018, issued a new release that said basically they're just limiting home equity line interest to only the principal that's used to acquire or to refurbish or renovate a primary home. So it is still deductible and subject to the same limitations. It's lumped in with everything else under the $750,000 limitation. So, and as you can see at the bottom there, these provisions are both effective for 2018 through 2025. So we will see these, eventually they will expire, but for now they're in place. All right, some big changes also with charitable contributions. All right, this is a change, I think that it's a good change. It's helpful to taxpayers. And so basically in the past, what you had was a limitation where you could only deduct for charity up to 50% of your gross income. Right now that number is up to 60%. So that's a good change. Also, there is a negative change, and this is something that may affect some of you in this room, if you're big football fans, the athletic seat rights, and you may already be feeling this a little bit. You know, the seat license that you pay or the rights that you pay to get your Carolina or your Clemson tickets, or whatever university you support, unfortunately no longer deductible. In the past, it was 80% deductible. So I think that's a big change. I think that's a huge change. I'm not sure that I've heard a whole lot about how that affected the universities over the past year. I'm guessing maybe there was a little bit of downward pressure on the universities and what they could charge. Although I guess Clemson, that probably doesn't apply right now. They're probably skyrocketing. They don't care. So right now they're pretty happy. They'll pay anything. But you know, I think it's a big change, and so we could see over the next couple of years that will begin to affect the pricing of that. I don't think it'll be a huge change, but it is. Again, you've got to consider it. It's no longer deductible. The final item there is substantiation exception for certain contributions. This is probably won't affect too many folks too much, but basically there was an exception for anything under $250 that didn't really have to be substantiated. That's no longer in place. But I think for the most part, if you're giving to a legitimate charity, they're going to give you a receipt or a letter that says you've given, so that shouldn't be an issue. All right, a change with casualty losses. All right, now a lot of us experienced this firsthand about 3 or 4 years ago with the 3.5 years ago with the flooding that occurred in Columbia, and we had several clients that took advantage of this casualty loss deduction. Well, unfortunately, this is suspended through the year 2025 unless you are in a federally declared disaster area. So, thinking back to the flood of 2015, that was a federally declared disaster area. The hurricanes that have occurred, they generally get the disaster declaration. It won't affect those, but what it does affect is something like, for instance, if you have a fire or a localized flood just in your area that's not a federally declared area. So those type of losses, if they're not covered by insurance, are no longer deductible. So that's unfortunate, but at least they did maintain the allowance for the federal disaster areas. Wagering transactions, probably not going to affect too many folks in this room necessarily, but there's a new limitation with the way expenses incurred in gambling, and probably this is going to affect mostly your professional gamblers or folks that are doing a lot of gambling. So really it's just a way that the expenses related to that are deductible. No longer can you create a loss as a professional gambler. So I don't know if we've had too much of that exposure at our firm, but maybe out west in Vegas or somewhere else that could be an issue with folks that are professional gamblers. All right, more changes with itemized deductions. Excuse me. This is a big one too. Miscellaneous itemized deductions, all right? So what does that encompass? Primarily, we're talking about things like investment fees and expenses, so what you pay to your broker. Those are no longer deductible. Tax preparation fees, what you pay to our firm for individual, at least for individual taxes, those are no longer deductible. And a really big one I think that's going to affect a lot of folks is unreimbursed business expenses, all right? So it's not just those specific items, but the whole universe of miscellaneous itemized. Those are just the biggest ones that we see the most often and have the highest dollar amounts generally. So what does that mean for you? If you're an employee, you might want to start thinking about talking to your employer and saying, hey, I've been spending money, maybe if you're in sales and you don't get everything reimbursed for travel or some certain things that you do to incentivize your prospects. Maybe you need to talk to your employer and say, maybe I need to get some reimbursements, or maybe I need to get a partial reimbursement because I'm now losing out on this deduction because it's no longer deductible on my tax return. So that could be a big issue. If you are an employer, you might want to think about talking to your employees and seeing how it is affecting them, and maybe having a shift in how you handle your expenses for your employees. Also, maybe I think we have a couple of investment advisors in the room. You maybe talk to your investment advisor and see how you structure the fees with your investments. If you have a management fee, that's a straight out fee or like a percentage fee, that most likely is going to fall under this and not going to be deductible. But if you're working into commissions on individual sales, that could be worked into the sale transaction. That's not affected. I'm not saying, you should try to shift one way or the other. I'm just saying, look at it. Look at it and see, you know. John, you're shaking your head. I don't know if that's going to affect you or not, but yeah. Well, that's my point. No one loves a commission, but I'm just saying that you might want to look at it and see, because there may be a situation that it's better to pay a commission than it is to pay a fee. I don't know. I'm just telling you, giving you the information. You do with it what you want. All right, the next item there, the PEAS limitation. This is actually a good thing because for many years we've had a limitation once your gross income goes up to a certain amount. I think it was around $300,000 to $400,000. Your itemized deductions actually started to become limited, and they were reduced. So that PEAS limitation is now repealed through the year 2025. So that's a good thing. At least there's no maximum cap, or there's no, we're not chipping away at those on the high end of the deductions. So that's good. That's a good thing. All right, a few miscellaneous items here. Actually, these are not, I apologize, these are not itemized deductions. These are just miscellaneous. I think I missed that there. All right, so inflation adjustments. This is just a shift in the inflation number that's being used to calculate things like rate brackets and standard deductions, things like that. They're now using the chained consumer price index, which is generally a little bit slower than the consumer price index. So you might see a little bit smaller increases in those standard deductions and in those rate brackets over the next few years. Probably not a huge impact, but it is an impact nonetheless. All right, as I mentioned before, the child tax credit. So we lost personal exemptions. So if you have children, you no longer get a personal exemption for them, but you potentially will be eligible for either just to get a child tax credit, period, or to possibly have an increased child tax credit. So that credit is now increased from $1,000 to $2,000 per child, and there's a new credit for qualifying relatives or qualifying non-child dependents. So if you're taking care of an elderly parent or another relative who's dependent on you, you can get a credit for that individual. And there is a phase out. If you're married, filing joint, it phases out at about $400,000. So above that amount, you're going to start losing it. But that's a much broader amount, or a higher phase-out amount than we had in the past. Yes, ma'am.
College children, they would not, that are over 17, they wouldn't qualify for that?
Correct. So the question is, college children or anyone over the age of 17, they're not going to qualify. They potentially could qualify for the dependent, I believe, the non-child dependent credit, even though they're a child. But if they're over the age 17, I believe they potentially could qualify for that. Again, we haven't actually run through that calculation or that exercise yet with any returns, but since this is brand new, but
Tony,
I think that's possible.
in other words, if you're a high school senior, 17-year-old, or if you're a college-age student who's still what we call a dependent, in other words, you would normally still show them on your tax return that would otherwise have a personal exemption, then they are going to qualify for that $500 credit.
All right. So John, just for the purpose of the video, John did confirm that if they're over the age 17, they don't qualify for the child dependent credit, the $2,000. They most likely will qualify for the $500. All right. The last item there, the 529 savings plans. This is a nice new feature for those of us that don't have college-age children yet, or have school-age children. If you put money into a 529 plan, you can actually, after the year 2017, which is current, you can take that money out and use it for for elementary and secondary, public, private, or religious school, up to $10,000 a year. So that's a nice new development for 529 plans. Yes?
So is that 10,000 per child or 10,000 per return?
I believe it's per child. You know, John, for sure? No, I don't. I think it is, but don't quote me on it. I'm pretty sure it's per child. Because generally, and the reason I say that is because generally 529 plans are measured per recipient or per beneficiary. So that'd be my guess. But I can confirm with you later. All right.
So the change there is that that only used to qualify for higher education, right?
Correct. The question is, did that only used to qualify for higher education? That's correct. Now it's being expanded from higher education into secondary and primary education.